Hi everyone, I'm Neha Vashisht Mahajan and you are here with me on ET Markets livestream, your one stop for everything related to markets and more. In today's show, we will discuss how you can take care of your debt and international fund investments. And for that, we have Dr. Mukesh Jindal, co-founder of Alpha Capital with us today. Welcome to ET Markets, Dr. Jindal.
Thank you, Neha. Thanks a lot for inviting me to the show. It's always a pleasure to be here. It's always good to share the insights with the audience. Thank you so much.
So, Dr. Jindal, let's start with the topic of the day. The tax rule for non-equity mutual funds changed back in April this year. So can we do a little recap for the viewers for the same?
Sure, Neha. It was a big move which came in the last financial year and was applicable from 1st of April. And, before I
Right.
tell you about what the changes came, I want to tell you about a famous quote. You must have heard about it from, the great Benjamin Franklin, which he wrote in 1789 that, in life there are only two things which are certain. One is death and the other is taxes. So tax is something which government is going to continuously increase, and India is a developing economy, government needs more tax. So I think this is
Right.
definitely going to go up. So yeah, before I tell you about what are the new tax rules and how does it impact the investor, in fact this is one tax rule which has impacted market in a big way. And so let me
Mm.
rewind a bit and tell you what were the tax rules till 31st March 2023.
Sure.
Now, one, this is applicable for mutual funds. And earlier, for taxation purpose, all the mutual funds were categorized into two categories. Okay, one was equity mutual fund, where the minimum equity exposure was 65% in Indian equities, and the other was non-equity funds, which did not
Mm.
invest, 65% in Indian equities. Now, the Indian equities were getting taxed long term at 10%, and the non-equity mutual funds got the advantage of long term after 3 years, and they were getting taxed at 20% but with indexation benefits. So there used to be effective tax rate of around 10%. And a lot of HNI
Mm.
investors, who have a tax slab of 30%, 40%, 20%, they used to invest big time into debt funds. Now, as per the
Right.
new rule, now, what the income tax says is now there will be three categories. Okay, one will be the equity fund category, which has not been disturbed, which will continue to be same
Mm.
like that, which will have, let's say, at least 65% in equity, and which will be getting taxed at 10% after 1 year. So there is no change. Now, the other category, the non-equity fund category, have been divided into two. Okay, one is a
Okay.
36% to 65% equity category. So any fund which invests 36% to 65% in Indian equities will get taxed at an earlier taxation rate for non-debt non-equity funds, which was, after 3 years they could qualify for long-term capital gain, and they were getting around taxed at 10% effective tax rate.
Mm.
And the new category which has come up, which doesn't invest up to 35% in Indian equity, will be getting fully taxed as per income tax slab rate. So, all the debt funds, all the international funds, they don't have Indian equity exposure. They have become
Mm.
fully taxable, completely as per income tax slab. Now, there are two, three important points on this which investors need to keep in mind. One, the old investments which were done till 31st March 2023 have not been affected. They have been given the
Mm.
grandfathering benefit. So whenever those old investments they sell anytime in future, they will get the old tax benefit. The new
Right.
this new tax rules are applicable only from 1st April 2023. And if you ask me, this also doesn't impacts majority of the investors, Neha, because India is largely a developing country. It only impacts people in
Mm.
the 20% or 30% tax slab.
Right. And like anything, this actually affected the whole investment system that was being followed by a lot of investors. So, what has been the impact of all this till now?
See, of course, there has been a big impact. And one is, the debt funds have lost attraction. And, investors used to participate big time into debt funds. The conservative
Mm.
investors, they were getting almost 7% post tax. So now you don't get that benefit. So debt funds have
Right.
lost its charms. Of course, there are some advantages that you there is no exit load in the debt funds. You sell at any point of time, you'll get the same rate. Unlike the fixed
Hmm.
deposit, when you break anything, you have to pay the charges and you get lower rate. Second, the benefit in the debt fund is that you pay tax when you sell, unlike the FD where the
Hmm.
tax gets you have to pay every year whenever it gets accrued. Those minor benefits are there, but the major benefit was a tax arbitrage, Neha, because in FDs it was fully taxable, and debt funds were getting taxed at around 10%. So debt funds have lost
Yeah.
attraction. Second big change which has come is the international funds. India was gradually started investing in international funds in the US markets, in
Hmm.
emerging markets, European markets, and clients had started investing in international markets. Like for our clients, we had almost invested 15 to 20% of our clients money in international markets, because it gives a diversification benefit. Rather than having all your
Absolutely
money in
right.
India, you could invest in US and other markets. Now, since
Hmm.
those international funds have become fully taxable, even it doesn't make sense to invest in them anymore. So since first
Hmm.
April, we are not seeing inflows so much in the the international funds and the debt funds.
International.
And also, what has happened is that hybrid funds as a category, it has become attractive because they still carry some tax advantage. So these are the major impacts in the market.
All right. Keeping this aside, what do you think is the alternate way for investors from now on?
Yeah, Neha, I think one, it's not a easy thing. Earlier, it was much
Hmm.
simpler. The debt funds were much easy to understand. So
Hmm.
what we have seen is that what investors are doing now is they are investing more in hybrid funds and categories like arbitrage fund. In fact, there are three categories which have become very popular. One is arbitrage fund, the other in a hybrid it is equity savings, and third is a balance advantage. I'll tell you what are the
Hmm.
advantages and how do they work. So,
Sure.
arbitrage fund, what it does is, 35% they invest in bonds, which is, what debt funds does, and
Hmm.
65% it invests in arbitrage strategies. So, how does arbitrage strategy works is that the fund manager will invest 65% in stocks, but the fund manager will hedge the exposure. He'll take a short position in the futures market. So, technically, the equity exposure, the net equity exposure in the fund is almost zero, and the arbitrage funds they give around 7% kind of return. Right now, of course, the
Hmm.
yields are higher, and the advantage is that they get an equity tax benefit. So after 1 year, if you sell arbitrage funds, then you will get post tax yield of around 6.3%. So compared to debt funds, it's not so attractive, but still it's something which is better. The second category which has become attractive is the equity savings fund, because equity savings is a hybrid category fund. What they do is
Hmm.
they invest, they have a net equity exposure of 20-25%, and balance is debt, but they have a equity
Right.
taxation. So majority of the
Hmm.
money being in debt, so you can sell after 1 year when it's long term, whenever the money is needed. And third is a balance advantage, where the fund manager keeps changing the money between equity and debt, but the net equity exposure is around 50-50. So you're trying to take
Hmm.
safe exposure through these hybrid categories. Not a very clean way of doing it, but yes, we are seeing very large incremental flows in these categories, and people who want to still be conservative can use these kind of funds for investments.
Right. So moving on, I want to talk about investor behavior. As you mentioned that after this move, a lot of people are not investing in debt and international funds. So what else changed when it comes to the investor behavior, and are investors changing their asset allocation as well?
Yeah, Neha, see, the biggest challenge is that investors have to change the investor behavior, the asset allocation
Hmm.
by default. Look at this way, Neha. Let's say there's a moderate investor. A moderate investor is someone, let's say, who parks 50% in equity, 50% in debt. Now, in debt, he was earlier getting, let's say, 7% post tax from the debt funds, and equity funds, he was getting around, let's say, 14%. So he was earning around 10.5% post tax on a portfolio. Now, with the
Hmm.
yields falling on the debt, because let's say he's participating in arbitrage, and let's say he continues to invest in equity funds, the post tax return of this combination mix has fallen from 10.5% to 10%. Okay. Now, that
Hmm.
0.5% which has been lost can only be compensated by increasing the equity exposure. So
Right.
investor who is a moderate investor has to increase his equity exposure from 50% to 55% to get similar return. And similarly, a conservative investor who normally invests 25% in equities and 75% in debt has to increase
Hmm.
his equity exposure from 25 to 30%, 35%. So there has to be a change in the asset allocation, which is required. And it's
Right.
very important investor do it, because see, the biggest killer in the whole story is inflation. See,
Hmm.
inflation is not coming down. Government reports an inflation of 6%. And, because India is largely a developing country and largely a
Yeah.
poor country, if you frankly ask me. And see, India as a country, we consume more of cereals like rice, wheat, and other things, which is price
Hmm.
controlled by the government. So inflation is not so much, because government looks at what is India consuming. But
Yeah.
let's say middle class, upper middle class, HNIs, they are consuming, fruits, vegetable, protein, egg. They're going to restaurants, education, healthcare. There, the inflation is around 8%. So any investment which is not giving you a post-tax return of 8% is technically you are eroding a capital. So after this taxation of the debt funds, investor has to increase the equity exposure in the portfolio. Investors
Hmm.
have to become comfortable with the volatility of the market. So it's not about being a choice whether you are a conservative investor, whether you are going to invest in equity or you're not going to invest. You have to increase that. And I think the most important thing about doing this is to increase the knowledge. See, equities,
Yeah.
people fear that it's risky, you can lose capital, but if it gets managed well, I think it's much safer than debt in the long term. It's a very safe investment, provided you have the knowledge. So my suggestion to all the investors will be that they should educate themselves about the market, become comfortable, and increase
Hmm.
equity allocation. And see, Neha, I think it is also good what government did. Because see, earlier there was an arbitrage opportunity in a FD.
Hmm.
You're making post-tax return of earlier 5.5%, and the debt, government was taxing you at a lower rate, and you were getting taxed at, let's say, 7%. So we had so many investors who were saying, "Yeah, leave the equity investments. I'm getting 7% safe, assured. I don't want to play the
Hmm.
equities."
Hmm.
So a lot of investors were heavily exposed on the debt side. And what was
Right.
happening is, we have so many investors who have invested in the debt for, let's say, 5 years, 10 years also. But they have
Hmm.
lost the opportunity of investing in equity and earning higher return. So thankfully now, as a country, we will be investing more in equities. And hopefully
Hmm.
this will enable higher return for the investors.
Just to talk a little bit more about this particular point only, do you think equity is now more preferred now that debt funds have lost their USP? And are people more interested in equity or still going for FDs instead of debt?
See, Neha, I think you're absolutely correct in a way that equities have become far more attractive now, and debt doesn't seems to be so attractive anymore. And it's not that people are replacing debt with the FD, and the reason being
Hmm.
inflation. They have to earn 7-8% post tax, and FD is not going to help them. In FD, you only
Yeah.
get 5% post tax for someone who is in a very high tax bracket. So what we are seeing, Neha, is that incrementally people are investing more in equities, and you can see this happening in
Hmm.
the equity markets. If you look at the markets since April, we have a fantastic rally. It's not just because the domestic investors, the FIs are investing, but if you look at the domestic flows, they continue to become stronger. And that's also
Hmm.
because today there is no alternative. See, earlier
Right.
investor could invest in debt funds. He was investing in US market, other markets. Now, all those windows are gone. So by default, we are making investors invest in equity. So equity as an asset class has become fantastic in the sense that, the domestic flows will continue to become stronger, which also means that there are two repercussions of this. One,
Okay.
equity will trade at a higher P multiple. So let's say
Hmm.
if the average P multiple, P is price earning ratio, and it tells us about the valuation of the equity markets. The long term average is around 18. Currently, the Nifty P is around, let's say, 22. So markets is overvalued by around 20%. Now I feel the average level of the fair value is not going to be 18 anymore. It may change
Yeah.
to 20 because of the huge flows which are going to come in, or they are already coming in. So market will
Hmm.
start trading at a higher PE, higher valuation. That is something which is going to happen. Second thing, what is going to happen, the volatility will also go up as you see
Yeah.
more flows. Investors will also get skeptical when markets fall. They may withdraw. So investors have
Hmm.
to become more comfortable, and I think also this in the coming years, this will also become a big bubble. We are in
Yeah.
an early cycle, but if in any particular asset class you keep investing more and more money, if it sees a lot of liquidity, the
Hmm.
valuations goes to a point where it becomes bubble. So investors have to watch for that. It's not that we are in a bubble zone right now, but I think next two
Hmm.
three years something where the markets can get into bubble.
All right. So I think that's all for today's topic. But before we take some questions from the audience, today we also had the RBI MPC meeting, which was concluded. This was the third day today, and a lot of big changes were introduced. But RBI maintained the status quo and kept the repo rate unchanged. So, do you have just two words to talk about on the topic?
See, I think this RBI policy was very much in line with what was expected. And I think globally, most of the monetary policies are now governed by what US does, what the US Fed does.
Yeah.
Till the time US Fed continues higher interest rates, till the time US Fed doesn't cut the interest rates, I don't think emerging markets or other countries are going to cut the interest rates. Because if
Hmm.
that starts happening, you will see foreign investors withdrawing money from bonds and investing in US market, and the currency may depreciate. So
Hmm.
I think what is more important is how does the US Fed behaves. And I also feel that RBI is doing a fantastic job. They're managing the whole monetary policy pretty well, and the decision what they have taken today are really good and makes a lot of sense.
All right. So now I'm going to take some questions from the audience. I'm going to take two, three questions only related to our topic of the day. The first question is how this taxation will affect international funds. So although we have discussed this already during our chat, but just briefly, if you could explain for the users.
Sure. See, one, the international funds have now become fully taxable, and which have made them unattractive, because it's not that
Hmm.
international funds gives you great return. It's more about the diversification. And the
Yeah.
rule is that at least a fund should invest 35% in Indian equity to qualify for that
Hmm.
old tax rule of 20% with indexation. What we expect in coming months, Neha, is that the fund houses will launch new international funds, which will, let's say, invest 65% in international equities and 35% in Indian
35.
equities, so that they
Hmm.
get benefit of tax in the sense of long term of 20%. I'm hoping that these kind of international funds comes up, because in portfolio it's very important to have those kind of opportunities, because US markets, other emerging markets are looking very attractive as well.
All right. The next question I'm taking is about debt funds only. Another user is asking what are the options for people who already have invested in debt funds?
See, the existing investors really don't have to worry. And because thankfully the government, what they have done is that they have not touched the old investments. The old debt fund
Hmm.
investments in 31st March 2023 have got the grandfathering benefit, which means that whenever you sell in future, you will get the old tax benefit. So if you decide to sell even after 5 years, and it has
Hmm.
completed 3 years of long-term capital gain, you will get taxed at 20% with indexation. So I think the old
Okay.
investors with old debt funds need not worry. Don't be in a rush to sell, because whatever you have, you're not going to get the tax benefit again now. So be careful in selling your old debt funds.
All right. Another question we have from a user named Pramod. He's asking, please suggest some other options apart from equity as well.
See, other than equity, there are a lot of interesting stuff which are happening, and a lot of alternate investments have come up. in the
Hmm.
sense, we investors are seeing a lot of interest in fractional real estate investing. For example, let's say, you don't want to invest in commercial properties or residential properties because it requires a lot of money. There are platforms now where you can invest, let's say, minimum of 10 lakhs, and they give you a
Hmm.
14-15% kind of return. Of course, they are taxable, and the risk is there because the investments can default, but for diversification you can also consider that. Sovereign gold bond is something which I'll highly recommend to investors, and provided you have a long term horizon. See, sovereign gold bonds are issued by RBI. The advantage is that they replicate the the gold prices, and they are a tenure of 8 years. Now,
Yeah.
it carries two advantages. One, it pays you every year 2.5% interest rate, and the interest, of course, is taxable. And if you hold the bond till maturity, then you get the gold price appreciation, but there won't be any capital gain tax. So whatever
Hmm.
gain you get from the gold bond is fully exempt. So I think this makes it attractive, and we expect that when the US Fed starts cutting the rate next year, the gold may see a very good rally. So gold bond is something which is attractive for very ultra HNI investors. There are private equity and VC funds which they can consider if they have a very high risk appetite. So these are some of the instruments which can be considered.
All right. Another question we have from Shubham Modi. He's asking, what about SBI Small Cap Direct Fund and also SBI Small Cap Mutual Funds?
See, both SBI Small Cap Mutual Fund Direct and SBI Small Cap Mutual Fund are same funds in the sense that they invest in the same stocks. It's just that the one is a direct plan, the other is a regular plan. In direct, the expenses are less. In regular, the expenses are higher. You do it
Hmm.
through your advisor. Now, the SBI Small Cap Fund, has been struggling lately, and the size has also become large. Though the SBI team is pretty good, hopefully it will bounce back. And if you have that exposure, maybe I'll suggest that give the fund one more year. Let's hopefully it will bounce back. But if you're doing a fresh investments in SBI Small Cap, then maybe you can stop it and consider some other small cap fund.
All right. One last question I'm taking by Amit. He's asking, are tax-free international bonds still available in the market and can we invest?
See, tax-free international bonds. So for tax-free international bonds, one, like how do we invest in them is through LRS, liberalized remittance schemes. So RBI allows you to remit money outside India up to $250,000 per investor per financial year. Now you can remit the money to different jurisdictions. Let's say you can remit the money to Singapore, Dubai, and
Hmm.
over there you get bonds. Okay, now you can get dollar denominated bonds. Indian bonds are also available over there. Now, whatever interest you get from there is fully
Hmm.
taxable in India. So there is nothing called tax-free bond. If you invest in those bonds in outside, they are going to become taxable. You have tax-free bonds available in India. The yield is around 5.25%. So if you decide to invest in tax-free bonds in India, you'll get 5.25%. But outside, if you pick up any bond, it's going to be taxable in India.
Okay. Okay. So, sorry, my mistake. Amit was asking about tax-free interest bonds.
Tax-free interest. So, maybe he was asking about the tax-free interest bonds in India. So there are many
Hmm.
tax-free Indian bonds in India. There are platforms you can do it. You can talk to your broker, and you can, look at the bonds which are giving you around 5.25% kind of yield.
All right. All right. Well, I hope that answers Amit's question, and that marks the end of our segment today. Thank you so much, Dr. Jindal, for joining us on ET Markets live stream and discussing the topic of the day.
Thank you so much, Nia. Thanks to everyone in the audience for listening to me. Hopefully, you'll find it good and sensible. Thank you so much.